Hey, what's up everybody? Welcome back to the channel. If you've ever stared at a pile of cash, like, say $100,000, and wondered how to turn it into a fortune without losing your mind over complicated strategies, you're in the right spot. Or maybe you're just curious about what the world's investing geniuses are up to in 2025. Either way, today's video is a game changer. I'm breaking down two powerhouse options, index funds versus ETFs, to see which one could juice up your portfolio the most. Plus, I'm throwing in a masterclass on building a monster dividend portfolio from scratch, step by step, no expert knowledge needed. And because I love going big, I'll reveal the top 5 stocks that super investors like Warren Buffett, Seth Klarman, Bill Ackman, and Monish Pabrai are clutching tight this year and why. Stick around to the end, because I'll show you how these strategies could transform $100,000 into multi-millions. Oh, and which option could tack on an extra $2 million while pumping out $30,000 more in monthly dividends. Let's dive into this epic journey. First, let's set the stage. Why even bother with a portfolio? Whether you're dreaming of quitting your 9 to 5 with passive income or just want your money to grow quietly in the background, investing isn't about tossing darts at a stock chart. It's about dodging life's financial curveballs, like inflation chewing up your savings or markets taking a nosedive. Picture this. You got $1 million in bonds at 5% interest. That's $50,000 a year, safe from Wall Street's roller coaster. Sweet deal, right? Not so fast. Over 12 years, with 3% inflation, that $50,000 shrinks to about $35,000 in today's buying power. Slap on a 30% tax, and you're down to under $25,000. Could you live on that? Nope. That's why a portfolio matters. It's your shield against inflation and market chaos. And here's a scary thought. Betting everything on one stock? Remember Enron? Lehman Brothers? One bad move, and poof, your money's gone. But what if you owned every stock in the market? Bad news at one company gets balanced by good news elsewhere. Your fate's not tied to a single player. As long as the economy keeps humming, your portfolio's golden. Sure, buying every stock isn't practical without ETFs, but it proves one thing. Diversification is your best friend. So, how do you build a portfolio that's both bulletproof and profitable? I've got a 3-step plan to craft what I call a monster dividend portfolio, one that grows your wealth and pays you handsomely along the way. Step 1. How many stocks should you own? The pros, like Buffett, love concentrated portfolios, betting big on their top picks. He's got that famous line, diversification is protection against ignorance. If you've got his billions and brain power, awesome. But for us regular folks, without his insider scoop or research army, going all in on a few stocks is like playing Russian roulette. I'd rather spread my bets and sleep at night. Studies back me up here. The American Association of Individual Investors dropped some truth in 2004. Owning just one stock jacks up your portfolio's volatility by 30% compared to a diversified mix. Your returns could swing 35% above or below the market. Some years you're golden, others you're toast. Here's the fix. 25 stocks cut that diversifiable risk by 80%. Push it to 100, and it's 90%. A 2014 study dug deeper, saying you need about 55 stocks in the US to slash 90% of that risk 90% of the time. More during crashes. For us, though, I say 10 to 25 stocks is the magic zone. Enough variety to stay safe, not so many you're buried in paperwork. Later, I'll unveil my 17-stock monster lineup. Trust me, it's a beast. Step 2. How much cash per stock? Predicting winners is tough. Baseball legend Yogi Berra nailed it with, it's tough to make predictions, especially about the future. Classic. Since we can't see the future, I keep it simple. Equal weighting. Split your money evenly across your picks. Why? Even pros with fat research budgets, like hedge fund gurus, struggle to beat the market consistently. Not because they're clueless, but because the market's a wild beast. If they can't always pick the champs, why should we think we can? Equal weighting sidesteps the trap of overloading on a dud. Got $10,000 in 12 stocks? That's $833 each. Got $100,000? about $5,882 per stock. No overthinking, no regrets, just balance. Step 3. Sector spread. More stocks cut risk, but if they're all tech or energy, you're still exposed. Same sector stocks move together. Think oil prices tanking and dragging every energy firm down. My rule: no sector gets more than 25% of your portfolio. Check the S&P 500. Tech's the biggest at over 15%, but it's spread out. Mix it up. When tech stumbles, utilities might soar. Don't force it though. If consumer goods are overpriced, skip M. And stay in your lane. Don't touch biotech if it's a mystery to you. Peter Lynch's golden rule? If you can't draw it with a crayon, don't invest. Words to live by. Now, let's get inspired by the masters. What are super investors betting on in 2025? These legends don't mess around. They pick stocks with steel-clad fundamentals and insane potential. Here's their top 5, starting at number 5, Meta. You know the deal: Facebook, Instagram, WhatsApp, Messenger. This tech titan hooks 3.35 billion people daily. Nuts, right? It's an ad machine, with over 97% of its cash from advertising. But Zuckerberg's got bigger dreams: the metaverse. Through Reality Labs, he's pouring billions into VR headsets and AR worlds. Catches: it's a money pit. $17.7 billion lost in 2024, while ads raked in $87 billion. Some pros love the vision. Others want that $18 billion back in profits. Why is it a fave? Meta's balance sheet is a tank. $44 billion cash, $33 billion short-term debt, $276 billion in assets against $93 billion in liabilities. Free cash flows a geyser: $10, $20, $30 billion yearly. Its moat? The network effect. More users, more stickiness. Number 4, Visa. Not a bank, just the wizard behind every card swipe. You tap, it pings your bank, gets the nod, and takes a cut. In 2023, it processed $5.2 trillion in payments, dwarfing MasterCard. Its moat's a loop: more merchants, more users, more bank cards. No credit risk, low overhead, 50% plus profit margins. $36.8 billion revenue, $20 billion profit last year. Cash flow paradise. Number 3, Amazon. E-commerce king? Sure, but it's the extras that shine. Third-party sellers, 200 million Prime subs, and AWS. The cloud cash cow, with $107.5 billion revenue and $39.8 billion profit in 2024. Retail's thin, $387.4 billion revenue, $25 billion profit, but AWS and ads are rocket fuel. Pros see a titan shifting to high-margin gold. Number 2, Microsoft. From Windows to Azure, it's a profit juggernaut. Last quarter, Azure's cloud hit $25.5 billion with a 42% margin. Office 365 and Teams rocked 57%. Recurring revenue, enterprise lock-in, AI upside, unstoppable. Top dog? Google. Search and YouTube ads drive $61.7 billion of its $80.5 billion quarterly take, with $27.9 billion profit. Cloud's weaker, but that search monopoly is a cash printer. These 5 share DNA: fortress balance sheets, cash flow rivers, and moats, networks, ecosystems, monopolies. Buffett's wisdom? It's not industry size, but a company's lasting edge. They've got it. But heads up, in 2025 they're pricey. Google's PE at 21, others in the 30s. Pros hold long-term, not always buying now. Okay, back to our $100,000 dilemma. Index funds or ETFs? Let's break it down. Index funds are baskets of stocks or bonds tracking benchmarks like the S&P 500. Your cash spreads across every company in the index. Passive, low drama, matching the market. Priced once daily at close. ETFs? Similar vibe, tracking indexes. But they trade all day like stocks. Buy or sell on your terms. Most are passive, some active. Both deliver diversification. You're not sweating one stock's collapse. And low fees, since no one's playing stock-picking hero. Over decades, passive beats active. Less drag, more compounding. Differences? ETFs offer trading flexibility. Index funds lock you in till day's end. ETF fees edge lower, but watch for commissions. Index funds skip those, but might demand $500 to $1,000 to start. ETFs? One shares cost, say, $420 for Vanguard's VOO. Fractional shares? You're in with less. Index funds like Vanguard's 500 need $3,000 up front, tougher hurdle. Now the showdown. My top 5 ETFs. Schwab US Dividend Equity, SCHD. Dividend Champs, low cost. Invesco S&P 500 GARP, value plus growth. Wisdom Tree US Value, undervalued studs. Invesco Dorsey, right financial momentum, hot financials. iShares Core, dividend growth DGRO, dividend hikers. Metrics? 2.38% yield, 14.08% dividend growth, 8.47% price appreciation. Top 5 index funds. Fidelity Midcap, balanced midsizers. First Trust Microcap, small but mighty. Fidelity Total Market, all U.S. stocks. Vanguard Infotech, tech giants. Vanguard Midcap Value, value midcaps. Metrics? 1.81% yield, 12.48% dividend growth, 9.2% appreciation. How'd I get these? Add yields e.g. 11.9% for ETFs, divide by 5, 2.38%. Same for growth and gains. John's got $100,000. Index funds first. Year 1, $111,010. Year 10, $291,739. Year 20, $914,024. Year 30, $3,159,435. $127, 827 yearly dividends, $10,652 monthly. Total gain, $3,059,435. $2, $175, 450 growth, $883,985 dividends. ETFs? Year 1, $110,854. Year 10, $298,382. Year 20, $1,085,143. Year 30, $5,051,264. $529, 928 yearly, $44,161 monthly. Gain, $4,951,264. $2, $664, 176 growth, $2,287,088 dividends. ETFs crush it, $1.9 million more, $33,509 extra monthly. Why? Higher yield and dividend growth compound harder. Still, index funds offer simplicity. ETFs bring income and agility. No $100,000? Click the next video, $6,000 monthly from $20 weekly. Like this? Smash that button and let's keep stacking cash.